Hey everyone, welcome to today's Explainer. Look, if you've been paying any attention to the financial markets lately, you know the cryptocurrency space can feel literally like the Wild West. But what if, beneath all the chaos, the memes, and those frankly shocking headlines, there's actually a readable structure? Today we're diving into the anatomy of a hype cycle. We're going to decode the raw data, the chart mechanics, and that wild crowd psychology that drives everyday people to just pour millions into meme coins. 623,000%. Take a second to really think about that number. That is the actual staggering 7-day surge we recently saw with a token called Asteroid Coin. I mean, in traditional finance, a 20% annual return is considered phenomenal, right? But in the meme coin space, you've got an asset with absolutely zero underlying business model going from functionally worthless to a multi-million-dollar market cap in just days. It perfectly highlights the sheer unprecedented volatility we're analyzing today.
So when you see a return like that, your immediate gut-level question is naturally going to be, is this a golden ticket to financial freedom, or is it a perfectly disguised trap just waiting to empty your wallet? Well, to figure that out, we have to understand that these astronomical numbers don't just happen in a vacuum. They're the result of highly specific mechanics and some really deep human psychology that we are about to break down.
Okay, let's dive into this. Our roadmap for the explainer has 4 quick stops. 1. The meme coin mania. 2. Decoding support and resistance. 3. Beware the value trap. And finally, 4. Spotting the market top.
All right, part 1, the meme coin mania, its absurd origins and those crazy vertical spikes.
You know, what's so fascinating about the current crypto environment is that major speculative bubbles don't require years of tech development anymore. Today, a massive financial bubble can be triggered by a single real-world event, or honestly, just a passing cultural moment. Let's look at the origins of a coin literally called Scam Altman. Back during the April 2026 jury selection for Elon Musk's $130 billion lawsuit against Sam Altman and OpenAI, Musk then deposed on X calling his rival Scam Altman. Well, literally hours after that post, some anonymous developer launched a Solana token with that exact name on Pump.Fun. No white paper, no development team, zero utility. It was a financial asset built 100% on a courtroom headline and a social media taunt. And what happened next? Try a 313,472% jump in just 24 hours. The token hit a $14.4 million market cap and generated nearly $27 million in trading volume before most people had even read the news about the lawsuit. This is the raw, unadulterated power of a narrative-driven pump. It proves that in this space, attention literally equals liquidity.
But here's what's really interesting about this slide. Notice the stark contrast in these metrics. You've got this massive $14.4 million market cap, but right beneath it, the actual pump swap liquidity is just $369,000. So what does that mean for you? It means the actual pool of money available to facilitate trades is incredibly thin. If just a single early buyer decides to cash out $100,000 worth of their token, the price doesn't just dip, it crashes instantly. A high market cap combined with low liquidity, that's the ultimate illusion of wealth. So how does a token like this actually behave over time? Let's map out the standard life cycle. We generally see 3 distinct phases here. Phase 1 is the vertical spike. This often ends in what chartists call a blow-off top, driven entirely by intense FOMO. Then comes phase 2, the cascading decline. This is where early buyers take their profits and late buyers end up absorbing the losses, creating this systematic bleed. And finally, phase 3 is the recovery bounce, where the asset desperately tries to find a technical floor, which perfectly brings us to the science of reading those exact floors.
Moving right along to section 2, decoding support and resistance, the chart mechanics.
When you're dealing with assets that trade strictly on human emotion and hype, you really need a way to map the chaos. So think of support and resistance as traditional market metaphors to help us do exactly that. Support is your safety net, right? It's a price floor where buyers historically step in, which increases demand and stops the decline. Resistance, on the other hand, is your price ceiling. It's the level where early buyers decide to take their profits, building up selling pressure that prevents the price from rising any further. Once we map these out, we can actually start to predict where a totally chaotic token might bounce and where it's just going to get rejected.
Let's apply this to the Asteroid Coin data. The bull case relies entirely on support holding cleanly. I mean, if high trading volume continues, community momentum could absolutely spark a second wave. But look at the bear case here. Not only is there sustained selling pressure from early whales, but Go Plus Security actually flagged a massive technical risk, a smart contract backdoor. The developer literally retains the ability to halt selling. Think about that. If you're analyzing technicals, you absolutely must realize that a smart contract risk like that can instantly invalidate even the strongest, most aggressive bullish chart pattern, period. Which leads us to Section 3, beware the value trap, the fundamental danger. Just because a coin has fallen sharply and found a support floor doesn't mean it's suddenly a great bargain. Often, it's just a trap. The Motley Fool defines a value trap as an investment that appears to be a great bargain due to low price metrics, but is fundamentally unstable and destined to fail. I absolutely love the analogy they use for this. They call it movie quicksand. It looks like solid ground when you step in, but it slowly, inevitably drains your portfolio down a hole from which there is basically no escape. Meme coins are incredibly susceptible to becoming value traps, mostly because of their heavy reliance on a fleeting news cycle. Let's go back to our Scam Altman example. What happens if the Musk and Altman trial settles quietly out of court next week? Well, the cultural narrative just dies. And because the coin has zero underlying utility, the exact second that live story ends, the demand vanishes completely. The price collapses back into that incredibly thin liquidity we talked about earlier, trapping anyone who bought the dip thinking it was a smart value play.
All right, final section, number 4, spotting the market top, market psychology and euphoria. So, how do you know when it's actually time to step away from the quicksands? For this, we have to look directly at crowd sentiment. When you study crypto investors on platforms like Reddit, you'll find some humorous yet surprisingly accurate metrics. One user noted, quote, "My grandma asking me about crypto is a surefire sign of the top arriving." Seriously though, when an incredibly complex, highly volatile digital asset reaches the consciousness of a demographic completely removed from technology or finance, you are witnessing absolute peak market euphoria. Consider what we can call the electrician anecdote. Another investor noted that right at the absolute peak of the market, a tradesman installing their new kitchen stove, a guy with zero investing experience, started passionately pitching Dogecoin as a guaranteed path to wealth. It's wild. This is basically the modern version of the 1920s shoeshine boy indicator. When mainstream retail FOMO is driving financial advice right there in your kitchen, a crash is almost certainly imminent.
So the crucial point here is knowing how to spot when the crowd is fundamentally wrong. To summarize, the top signals you need to watch for include uninformed retail investors giving aggressive financial advice, mainstream media suddenly running extreme hype segments, completely dead or abandoned crypto projects suddenly pumping to all-time highs, and quantifiable metrics, like the Fear and Greed Index, just getting stuck in extreme greed, like above 90 for days on end.
By dissecting these origin stories, those liquidity illusions, technical support floors, and the overall psychology of euphoria, we can finally begin to see the underlying architecture of all this market chaos. Which leaves us with one final vital question to ask yourself as you navigate these waters. Are you trading based on data and structure, or are you simply caught in the crowd's FOMO? Really think about that as you continue your learning journey. Thanks so much for joining me on this explainer, and I'll catch you next time.